Welcome back to the AlgoBot channel, where we break down automated trading strategies for MetaTrader 5, one idea at a time. I'm AlgoBot, and today we're exploring an expert advisor called Tukey Fence Reversion. This strategy borrows a classic tool from statistics, the outlier test used in boxplots, and applies it to price. It watches for bars that stretch unusually far from the recent trading range, then looks for price to snap back toward fair value. By the end of this video, you'll understand the quartile math behind it, how it enters and exits, and how it manages risk. Let's dig in. So what exactly does this expert advisor do? Tukey Fence Reversion is a mean reversion strategy, sometimes called a fade, that treats recent price like a statistician would treat a data set. It takes the last several dozen closing prices, sorts them, and finds the quartiles, the 25th percentile, the median in the middle, and the 75th percentile. The distance between the outer quartiles is the interquartile range, or IQR. John Tukey, the statistician who popularized the boxplot, defined an outlier as any value that falls beyond a fence placed a multiple of the IQR outside those quartiles. This expert advisor uses that exact idea on the chart. Why quartiles instead of a simple average and standard deviation? Because quartiles are robust. A couple of sharp spike bars barely move the median or the IQR, whereas those same spikes would inflate an average and its deviation bands. That means when a bar pierces a Tukey fence, it represents a genuine overextension away from the body of recent trade, not just ordinary noise. The strategy trades a single symbol on a single time frame, whatever chart you attach it to, so it works the same on foreign exchange pairs, indices, or metals in the strategy tester. The only indicator it relies on beyond the quartile fences is the average true range, which it uses to size stops and targets and to measure whether the market is flat. Who is this style suited for from an educational standpoint? Traders who are curious about statistically grounded, counter-trend ideas and who prefer fewer, more selective signals over constant activity. Because robust fences fire rarely, this is a patient approach. Remember, though, mean reversion carries real risk. Losing trades happen, and no method removes that. This video is for learning only. Let's walk through the logic step by step, exactly as the code executes it. On each newly completed bar, the expert advisor rebuilds its distribution from the last window closes, 40 by default. It sorts them and computes the first quartile, the median, and the third quartile using linear interpolation. Subtracting the first quartile from the third gives the interquartile range. From there it places two fences. The lower fence sits the fence multiplier times the IQR below the first quartile, and the upper fence sits the same distance above the third quartile. The default multiplier is 1.5, which is Tukey's classic outlier threshold. Next comes a crucial filter, the flat regime gate. The strategy compares the current median to the previous bar's median. If the median has moved by more than a fraction of the average true range, 30% by default, the market is considered to be trending and no new fade is allowed. This is the guard that keeps the strategy from fading a strong directional move, which is the classic way a reversion approach suffers large drawdowns. If the market is flat, the expert advisor looks at the two most recently completed bars. The older of the two is the outlier candidate. The newer is the reclaim candidate. For a long setup, three things must line up. First, the outlier bar's low must pierce below the lower fence, a real statistical outlier. Second, the reclaim bar must close bullish above its own open. Third, that reclaim close must snap back inside the fence and finish above the outlier bar's close, showing net upward progress. When all of that is true and no position is already open, the strategy signals a buy at the ask. The short setup is the mirror image. The outlier bar's high must pierce above the upper fence. The reclaim bar must close bearish, and its close must fall back inside the fence and below the outlier bar's close. That signals a sell at the bid. Risk is handled with the average true range on both sides. For a long, the stop is placed a stop multiple of ATR just beyond the outlier's low, and the target is a take-profit multiple of ATR back toward fair value. Shorts mirror that. Finally, once price travels the break-even distance in favor, the stop is pulled to the entry price, and only one position is ever held at a time. Let's read the core of the MetaQuotes language code as you'd see it in MetaEditor. At the top are the inputs. Windows sets how many closes form the distribution. Fence multiple is the Tukey multiplier of the interquartile range, 1.5 by default. ATR period drives both the stops and the flat regime gate, while FlatSlopeFrac defines how horizontal the median must be to allow a trade. SLATR multiple and TPTR multiple size the stop loss and take profit in multiples of average true range, and break-even ATR controls when the stop is moved to entry. Lots and Magic set the fixed position size and the identifier the expert advisor uses to track its own trades. Now the long block. The Boolean long setup is true only when 4 conditions all hold. The outlier bar's low is below the lower fence. The reclaim bar closed above its open. That close is back at or above the lower fence, and it finished above the outlier's close. When long setup is true, the code reads the ask, sets the stop a stop multiple of ATR below the outlier's low, sets the take profit a take profit multiple of ATR above the ask, and calls trade.buy with those levels. The short block is the exact mirror. Short setup requires the outlier bars high above the upper fence, a bearish reclaim bar, a close back at or below the upper fence, and a close beneath the outlier's close. When that's true, the code reads the bid, places the stop a stop multiple of ATR above the outlier's high, sets the take profit that distance below the bid, and calls trade.sell. Both sides are symmetric, and both anchor their risk to the outlier extreme. Let's bring this to life on the chart. Across the price, you can see 3 dashed reference lines drawn from the strategy's own math. The middle line is the median, the fair value at the center of recent trade. Above it sits the upper fence, and below it sits the lower fence, each placed 1.5 times the interquartile range away from the quartiles. Notice how flat those lines are. That flatness is the strategy's flat regime gate at work. The median is barely moving, so the market is balanced and fades are permitted. Watch the opening candles. Price is drifting gently around the median, printing small candles that stay comfortably between the two fences. This is exactly the kind of balanced, ranging behavior the strategy is built for. Nothing to do yet. The expert advisor is simply measuring the distribution and waiting. Then comes the 4th candle, and it drops hard. Its low pierces well below the lower fence. Statistically, this is an outlier, a move far beyond the body of recent trade. A less careful approach might buy right here, but this strategy refuses to catch a market mid-plunge. Instead, it marks this bar as the outlier candidate and waits for confirmation. That confirmation arrives on the very next candle. Price stops falling, turns, and closes bullish above its open. And crucially, it snaps back up inside the lower fence and finishes above the outlier bar's close. All 3 long conditions are now satisfied inside a flat regime, so the buy entry marker prints. The expert advisor enters long at the ask. Its protective stop is placed a stop multiple of average true range just beyond the outlier's low, below that fresh low you can see. So if price keeps falling, the loss is capped and defined. Now follow the trade. The next couple of candles push steadily higher, climbing back toward the center of the range. As price travels the break-even distance in its favor, the stop is quietly pulled up to the entry price, removing the initial risk. Price continues up until it reaches the take-profit target. Set a take-profit multiple of ATR back toward fair value, right around the median. The take-profit marker prints, and the long is closed. Notice the logic. The trade was a bet that an extreme stretch away from fair value would revert back to it, and the target sits exactly where fair value lives. Now the mirror image plays out. After the long closes, price settles back around the median for a bar or two, still flat, still balanced. Then a candle pushes sharply higher, and its high breaks above the upper fence. That's an upside outlier, an overextension above the recent range. Again, the strategy does not sell blindly into strength. It flags the outlier and waits. On the following candle, price rejects. It closes bearish, below its open, and falls back inside the upper fence, finishing below the outlier bar's close. The short conditions are met, and the sell entry marker prints. The expert advisor enters short at the bid, with its stop placed a stop multiple of ATR just above the outlier's high, above that fresh peak. From there, price rolls over and works its way back down toward the median. Just as before, once the move travels the break-even distance, the stop slides to the entry. price reaches the take-profit target back near fair value, the take-profit marker prints, and the short is closed. Both trades share the same shape. An outlier stretches price beyond a robust statistical fence. A reclaimed bar confirms the snapback, and the target sits at fair value, while the stop sits just past the extreme. With the default settings, the take-profit distance is larger than the stop distance, a reward to risk of roughly 1.5 to 1 on each fade. And because the fences only flag genuine outliers in flat markets, these setups are meant to be selective rather than frequent. And that's the Tukey Fence Reversion Expert Advisor from start to finish. We saw how it borrows the statisticians' outlier test, quartiles, the interquartile range, and Tukey's fences to spot bars that stretch unusually far from fair value. We covered the flat regime gate that keeps it out of strong trends, the reclaim bar that confirms the snapback, and the ATR-based stops, targets, and break-even logic that manage each trade. Everything here is for educational purposes only. It is not financial advice, not a recommendation, and not a promise of any result. Trading carries real risk, and losses are part of it. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling us which strategy to examine next. You'll find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.